We will be starting with liquidity risk modeling, liquidity risk subject and topic. In this, we first start with the introduction of liquidity risk and building blocks to cash flow modeling. So, liquidity risk management. What is liquidity risk management? Basically, liquidity risk management in a financial institution in a bank is not concerned with the profitability. Generally, when we think about a bank, financial statements, money, cash flows, we think about profitability that we need to, our operations need to lead to profits for the company. But profits do not always mean liquidity. A company doing profits does not always mean that it has enough cash flow, enough balance in its accounts at a point of time in case of any contingency or in case of any unforeseen events. So, it is very essential for an institution like a bank or a financial institution to always be good with their liquidity, to always have a balance of their assets and liabilities, their cash outgoings and cash incomings, and having a balance, always having some balance in their bank account so that they can tackle any kind of unforeseen requirements, unforeseen withdrawal of money, or unforeseen events that happen. So liquidity risk management is not concerned with profitability. It is concerned with the cash inflow and cash outflow within an institution at different points of time in order to maintain liquidity, to keep the bank safe in terms of liquidity. To prove this, there is an example where we have deposits as well as loans. Deposits are the liabilities of the bank, and loans are the assets of the bank. Deposits is the money that has been added to the added to the bank accounts of the members of the bank, and loan is the money that is given to the members of the bank who need the money for different things, so the money goes out. So we have listed out some of those amounts, and here we are basically making a term structure of expected cash flows. So what is this? It is either that we list down all the cash flows, inflows and outflows that we know, or we forecast that in the future what can be the cash inflows and outflows in an institution. And when we list it down here, there is a graphical structure that has been built based on that. As you can see, in year 1 there are 20 crore deposits. In year 2, 10 crore is given as loan, 50 crore is deposited in the third year, 70 crore is taken out of the bank as loan in fourth year, fifth year deposit of 30 crore, and year 6 is loan of 20 crore. So in this scenario we are taking a 6-year forecast. It's just an example, and we can see, and the yellow line here is representing cumulative cash flow. This is the combination, the balance of inflows plus the outflows. So in year 1 we have cumulative cash flow of 20. When the next year, uh, 10 crores is given out as loan, it is an outflow. So we, in the bank, we are just left, the bank is just left with liquidity of 10 crores. In the third year, when 50 crores is the net deposit into the bank, the internal liquidity of the bank increases to 60 crore. In this, as similarly in the next year, you can see it goes down to minus 10 crores. So means there is no liquidity in the bank. It is a negative. In the next year, when 30 crore is deposited, it's again the liquidity in the bank. The cumulative cash flow is 20 crore, and in the sixth year, as you can see, it goes to zero. So in this entire scenario, we can see the bank is functioning. But in this fourth year, when there is a withdrawal or loan is taken out of the net loan is given out from the bank, or withdrawal is, it is basically net cash outflow for the bank of 70 crores. The liquidity of the bank is minus 10 crores, which means there is no money in the bank. This is negative cash flow. And this is where the scenario is that if there is any contingency, any unforeseen event that takes place, which causes unforeseen amount of loss to the bank, and they have to immediately manage it with additional cash flow. By putting in additional cash flow, they are left, they don't have any liquidity to put in, which makes the bank at a very vulnerable spot. So this is a very not ideal condition or a bad condition for a bank, and this is what needs to be managed. And this is why we learn liquidity risk management. So this was a general example to show how even if a bank is functioning, even if it has profits, there can still be risk in the bank if it lacks liquidity, if it does not have enough cash flow, cash inflow, enough net inflow in the bank to back itself up. From this, we get to know what is liquidity risk. We now get to know what is term structure of expected cash flow. The next thing is that liquidity risk is divided into two: funding liquidity risk and market liquidity risk. Now, what is funding liquidity risk? Liquidity risk is basically the risk that at any point of time the bank may experience shortage of cash flows to meet its liabilities. And what is market liquidity risk? Market liquidity risk is that we have some assets to sell. The bank has some assets to sell, but due to the economic scenario or the market conditioning overall, it is not able to sell it at its right price, at its ideal price. It has to sell it at a lower price, which means that in this case, the bank, when it has to sell a certain asset, it is actually hurting itself by selling the asset at a lower price than the valuation. It is incurring an unnecessary loss. But this the bank has to do in certain cases where there is emergency or where there is an economic financial crisis that occurs in the markets at some points. But we are not going to start by talking about market liquidity risk here. The above example that has been shown and the minus 10 crore cumulative cash flow, which is negative cash flow that has occurred, which shows that the bank is at a at a vulnerable spot at this point of time. What is this? It is basically not having enough cash flow, net cash flow within the bank to meet its liabilities, which is funding liquidity risk. So we are talking here about funding liquidity risk. We'll get deeper into funding liquidity risk now. So basically, funding liquidity risk can happen in different timelines. It can be short term, medium term, long term. It can also be intraday, and it can also be an unforeseen event, a contingency liquidity risk which just arises immediately, which is not thought about before. And now, in order to maintain and to manage this liquidity risk and to measure liquidity risk, let's say in case of the Indian banking system, there are two kinds of methods that are used. One is SLS and the other is DLS. SLS is statutory liquidity statement, which we are going to use quite a lot in the coming times. Whereas DLS is dynamic liquidity statement. Now, what is dynamic liquidity? Okay, first let's understand what a statutory liquidity statement. Statutory liquidity statement is basically where, again, we make a term structure for all the cash flows in the bank. We forecast all the cash flows of the bank based on current past transactions, that in which year and in on which date, on which timeline money will be withdrawn. There will be uh, ca- uh, deposits into the bank. uh, then forecasting for potential the loans that we have given to certain players, interest income generated on those loans, and then the interest to be paid on the deposits made by lot of bank members, lot of bank account holders who have deposited money in the savings account or the FD of the bank. Forecasting all that forms the statutory liquidity statement. Then what is dynamic liquidity statement? In this case, it goes even further, where we basically do a huge bunch of modeling. We build models in order to forecast based on the entire sample size, the data that the bank has till date, past data, current data, in which year, based upon the economic condition of the market, of the country, of its surroundings, the financial condition of the surroundings, whether the market is in a boom state, in a rising state, or it is in a recessionary state. Based upon all of that, further forecasting is done to see when will the bank have more debtors, when will it have to pay give more loans, how many loans will it have to give in a certain year, how many deposits will happen in a certain year, those kind of things. The the additional income that can be generated which cannot be seen today, which is just forecasted, modeled. So this is a pretty complex uh, way to measure liquidity risk, and thus this has been discontinued by banks, as this can lead to lot of risk of manipulation in the bank's financial and liquidity management data. So this is not used by Indian banks now. What is used is just structural liquidity statement. Now, I forgot to mention a point here, so let me introduce it. That liquidity risk measurement is measurement which is divided basically into a very stock approach. Now, what is stock approach? This includes measuring liquidity risk based upon static data, and thus done using calculation of certain very static ratios. There are a lot of ratios that have been prescribed, which are measured to measure the liquidity risk conditioning of the bank. But this is not a very good approach, because financial data is very dynamic. It continuously evolves, right? So just using a very stock approach is not the right idea. So the approach that is used is known as flow approach. In this, data is taken on real time, on time series basis. It keeps on updating, and then forecasts are made. And to make these forecasts, keeping in mind the future cash flows, जिनको हम लोग which are modeled basically, there it is done using SLS method and DLS method, out of which nowadays Indian banks and Indian Bank Association, the head of Indian banks, basically does not prescribe this method. Only SLS method is used, which we have already discussed what it is. Then we have discussed short-term liquidity risk, medium-term liquidity risk, long-term liquidity risk. Now, for short-term liquidity risk and for intraday liquidity risk, there is a way to measure funding liquidity risk. And for that, the bank, the head body of all the banking institutions, has prescribed what is very commonly known as LCR, liquidity coverage ratio. Now, how is liquidity coverage ratio calculated? Liquidity coverage ratio is basically done by using certain amount of the cash flow data of the bank and then putting it under a stressed scenario, a stressed condition, a hypothetical modeled situation where there is a crisis kind of a thing. It's a stress scenario, and then seeing, does the bank have enough liquidity during this to pass this stress scenario. This is what is done in liquidity coverage ratio method of measuring liquidity risk. So it's based upon simulation of data and putting it into a stress scenario and seeing if the liquidity test is passed by the bank. And another liquidity risk measurement is done is based on contingency liquidity risk, which is just immediately, which was not thought of before. We are not going to talk a lot about this one here. So based on this, what do we understand? What is the meaning of checking liquidity? Checking if the liquidity of the bank is all right is to forecast the cash flows of the bank in different maturities, in different time zones in the future, taking for all the cash inflows, cash outflows, and seeing if there is a cash flow mismatch. And also seeing whether this cash flow mismatch is on the positive side, which means inflow is more than outflow, or the outflows are more than inflow. So if the outflow is more than inflow, this means that the bank does not have enough cash flow to meet its liabilities if it is immediately required to. And this causes liquidity risk. Now, as we use the SLS method further, we need to understand that the higher bodies in the banking association have made certain time based maturity buckets, means 1 day or 7 days or 30 days or 1 year, 2 year time based buckets in which all the cash inflows and outflows that we forecast have to put into to form a model, and based on that liquidity measurement is done, and based on this liquidity surplus or deficit is measured. So these bucketing assumptions, as I said, are made by the regulators of the banks through regulatory guidelines, and there is a committee in every institution. There is this committee, ALCO, known as Asset Liability Committee. Now this Asset Liability Committee basic role is to review, is to create strategies, is to supervise all these cash flow assumptions and the entire modeling process, forecasting process, and measurement of liquidity risk. This comes under the ALCO division in a financial institution. Now, how are these bucketing assumptions made? These bucketing assumptions are made in three forms. One is definite maturity, or contract based maturity, or residual maturity, in whichever way you can call it. So basically, suppose somebody has deposited money into the bank for say 2 years, and they're going to withdraw it after 2 years. It is contractually defined. So we then have the right, we have the assumption, it is given that we put this into the 2 year bucket of cash outflow, that this money will go away, will be withdrawn in 2 years, in 2 years time from today. Then there is behavioral maturity. Now, in case of contracts, in case of financial products where contractual maturity is not defined, some examples are bills payable, saving deposit, current deposits, where the tenure of the product is not defined. There, modeling is done. in order to identify based on past historical data, current data, and these models are regularly updated to see when these products were used, when these contracts were used earlier, what was the behavior of the contract holders, of the parties with which these contracts were done, when did they withdraw their deposits, or when did they make their interest payments, or did they fail to make their interest payments, etc. It is done based upon modeling. So this is behavioral maturity. And then there is the third method, which is linked to the market, which is linked to the market liquidity. So if there is good liquidity in the market, or there is bad liquidity in the market, depending upon there is recession in the market, or there is a boom state in the market, and this is known by the term deficiency. All right, we'll not go. I don't have much more details about this third way of making bucketing assumptions, but this third one is known as deficiency. So we listed definite maturity, or contractual, or residual maturity, right? Then, for which we use modeling, is behavioral maturity, and third is based on market liquidity, known as deficiency. All right, that's all for today. Thank you.